Good morning, traders and investors. Welcome to it, Pre-Market Prep. I'm excited to get into today's show. We'll talk about the new bull market. It looks like a breakout to the upside. Can it last? We'll take a look, of course, at Walt Disney's earnings. Looks like the House of Mouse is doing well here. We'll take a look at their price changes and everything that happened. We'll talk about the financials coming to life. We'll also get into lawsuits around Zantac. We'll take a look at, of course, when the numbers hit. We got producer price index today, initial jobless claims, and of course, our special guest today, Cameron Dawson, CFA and Chief Investment Officer at NewEdge Wealth. Are you guys excited to get into another round of pre-market prep where you get started and get everything that you guys need to get the markets going here? Welcome to pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
All right, traders, I see you guys excited that we will be having Cameron on today. Let's bring on Joel Elconin. How we doing, Joel?
Oh, we're ripping here. We're continuing on from that 8-day consolidation breakout to the upside yesterday. Traded very little under the close of 42.10. That's been the high close of the rebound. Low 06.75 doesn't feel like we're ever going back down there. Just making new highs as we go. I can't give you any daily resistance, folks, because there isn't any. 4,300 is your next daily highs. That's just what the market's given me. I'm not making it up. 43.02.75. That was your high on May 5th. Your high on May 4th. 43.05 even. So, well, I'm sure we'll develop some levels in between here and there, but right now things are wide open. Crude rebounding from the 87 handle yesterday, up $1.14, 93.07. You have gold still above 1,800, down 210 at 1811.50. Silver in the red by 15.7 cents at 20.585. Another good day for Bitcoin, back over 24K, up 1,015 at 24,670. And Ethereum futures, two of the big leader yesterday, they're up $97 at 19,1850.
I'm in full damage control here. I'm just on the wrong side of a lot of stocks today. So I'm going to try to do the show with you, but I'm like, it's all big caps. I'm not going to talk about what I'm in, but I'm just on the wrong side of a lot of stuff today.
All right. Well, why don't you let Mitch just take the lead here?
Yeah, take the lead. I'll try to give some analysis
and then
here.
If you want to, if you have something that you want to comment on, we'll just, do it. Let Mitch do the preview. I'll do the setup. And then if something gets in, if not, man, damage control, man, that's what it's about. You can't control the news. And we got a lot of pharma news this morning.
And like we always say, risk assessment first, risk control first. Worry about that, Dennis. We got this. Let's talk a little bit. And this is just talk, right? New bull market from the bottom, right? About 20% up from that low. Now we're really starting to come back. Now, a lot of what you'll start seeing is a lot of people mentioning technically a bull market coming back. We've had a breakout to the upside. And now we're going to start seeing our investors trying to play catch up. Are people just feeling like they missed the boat, especially if you were maybe in the bear camp, that I was a part of, and now you're starting to see that upside move? Does the FOMO start getting you to going into buying today? Comments like this is what I was looking out for, and you saw Kramer step up to the plate. He said peak inflation is nirvana for stocks, especially out of favor stocks like fast-growing tech names or the financials or the consumer discretionary names. He said that this means that you can buy everything from Microsoft to Wells Fargo to Target to even Disney. That was a comment given by Jim Cramer yesterday. What do you feel about that, Joel?
I feel like he should listen to the Benzinga's pre-market prep show. 'Cause he's like, we've been talking about this for 2.5 months. I mean, uh, we had a big decline. We were all worried about Q2 earnings season. We got through that. We're all worried about inflation. In fact, I mean, I like the number came in line. That's the way the market reacted. So I'm not saying not selling. There's no reason to be selling into this rally yet. But I mean, if you're starting to build positions now, I guess it just depends what you're in and what your targets are and your risk reward ratios are. But I don't know. I just kind of feel like that's old news.
Do you think that we're still in a moment right now where it's a buy everything moment? That's pretty much what he's given yesterday. So now
I
going
never
to buy
think it's a buy
everything.
everything moment.
Agreed with
That's
that.
not the way. I mean, look at the pharma today. I mean, it's
I don't even know what's going on with Pharma right now. Like GSK starts GSK SNY overseas, but they're just absolutely hammering everything Pharma right now. I can't even figure out why. Like, was there something with a bill? I mean, everything like in the XLV right now is just like getting hit pretty hard. So, Pfizer, that's something to do with Zantac. Like, I don't follow the Zantac thing closely. Obviously, something to do with it. It's down 3.9%. It's a huge move. I have that in the long-term portfolio. But GSK, go into it. Like GSK, SNY, I mean, these are huge moves for very, low beta stocks. I mean, GSK is widely owned in Europe as much as Pfizer is in the US. This is your biggest pharmaceutical company in Europe. SNY as well. SNY is down 9% right now. So obviously this is off the Zantac news. Maybe you can hunt that down, Mitch. It started yesterday. So you can see yesterday with SNY, it's 48.95 2 days ago, and then just kaplooey. I mean, they hammer that thing. I have no position in GSK or SNY, but I do have some positions in Pharma. It's not going well. 43.20 was the lowest. Now 41, obviously trading over in Europe, so it's already pricing in where it wants to be. Serious sell-off here this morning in some pharma stocks.
Continuation too. I mean, these things got whacked yesterday.
Yeah, this is all on litigation about the recall on the heartburn drug Zantac. I will say it right off the top. I've taken Zantac a couple of times and more than handfuls. But Zantac was once a popular antiacid that was drawn a fury of U.S. personal injury lawsuits alleging the causes of cancer. I didn't even know this, but this was interesting. I didn't even know it was off the market, but Zantac was withdrawn from the market in 2019 after the U.S. Food and Drug Administration said it appeared to produce an unacceptably high level of cancer-causing chemical when exposed to heat for as little as 5 days. So this is all coming off of the lawsuits around this. GSK declined to comment on the stock moves and ongoing lawsuits. Haleon said that it's not a party of the litigation proceedings and that it's never marketed the drug in any form. That one's still getting hit HLN. Damages could possibly reach 10.5 billion to 45 billion, according to an analyst at Morgan Stanley.
I mean, they're selling and asking questions later. I mean,
but they're selling every pharma stock now. Are they worried like this is spilling over their other drugs? Like, I mean, I'm just looking at the U.S. drugs. You can look at the XLV, Joel, which obviously owns a lot of them, just to get a feel for it. I do have a position in that, trying to hedge myself a bit. I mean, it's down 0.5%, so you're not going 1% out. But I mean, there's just so many. I mean, like Pfizer too, down 4% now here. There's just a pile of big pharma just getting smacked around. Is this all off? Like, I don't know why, if there's a bill, I'm not even in the chat. I've been getting hit so hard here today. I haven't had time looking at the chat here. Chat's usually pretty good at what's going on. I'm just wondering if there's like something that was said on the bill front or something with drug pricing.
That's true. In the Inflation Act, Toronto Dave, they did include some pharma price capping. And
when did that come out though?
A couple days ago.
Yeah, that's what I'm saying. What's come out in the last 20 minutes? Because it's just kind of really started. Unless it's just wicked rotation too. And, it's full risk on. And we talked about pharma not going to be the place to be if we go into a risk on market. And that's absolutely the case. I mean, this is just, every single pharma stock is down here this morning. So maybe it's off this. They're spooked on the GSK SNY that they could be sued for billions of dollars. Maybe that's what's happening here. but it's a serious sell-off in Pharma here this morning. I mean, you come in and you say, what a great day for the markets. You own Pharma stocks, you're like, what the hell is going on?
It's definitely something that I think it's
Lily's
moving the
down
markets,
$3 now. It's just spilled over into every single Pharma stock.
I don't see anything in the comments. I don't think anyone knows something that we don't know, at least for the time being. I'll see if anybody puts something up, but for the right now, it looks like people are mentioning the bill also. Maybe that's a part of it, but
that was
looks
2 days ago. I don't know if that was an update to that or something. Somebody said something, because it feels like this is more than just Sanofi and GSK. It feels bigger than that, just because these pharma stocks are getting hit so hard right now. So anyways, maybe I'm just a selective perception on my part. There's a lot of stuff up today. I mean, you got the airlines, the cruise lines all trading quite a bit higher. You've got a full-on risk-on market. Retail, banks are trading up.
Pam wants your definition of risk on, Dennis.
What do you mean? What's my definition?
Well, she says, can you give a definition of risk on? And that's
when you're seeing all the high beta stuff going up.
Crazy.
I mean, so the way I can assess it quickly is I got like a screen with like all sectors broken down, like 200 stocks. I got like Pharma in the corner, which is just bleeding out. And then I've got a lot of other stuff that's green. So I just look and I can see tech. Tech's fairly strong. I see ARKK up 1.22%. Shopify up 3.5% here today. So, these are risky stocks. So it's risk on those stocks. But then you come around and, the other stocks here, like just saying there's so much here that is, conservative stocks are really getting hit here today. So those stocks typically do well even when the market's going down. They almost move counter to the market. So it could be a little bit of rotation there too this morning, but it's like seems a little bit more violent than that. It seems a little bit more like, no, there's news on the entire pharma sector.
Yeah, J&J is getting hit too. Everything.
And that's a stock that moves around 50 cents a buck a day. It's down $2 right now. Full disclosure, I have a position on that one. So I mean, there's it's very interesting to say the least. This is actually not a quiet morning. And then we're gonna get what 8:30 number. We're gonna get again, right? When's the number? Is that 8:30, Mitch?
Yep.
8:30. Yes, correct.
Yep.
Yeah. So you're gonna get more information here coming too. I mean, rah bull. It's good. We're taking out 420. The market's good. My Disney's doing awesome. I'm up in Disney. I was been getting hammered in that thing forever in the long-term portfolio, and boom, it's it comes in.
You gotta be up in it now.
I'm up in it. Yeah.
Before we go to the Disney,
I started buying it at 151, and then I bought like 125. I started buying 105. It was like the whole Kathy Wood out, never frown average down. I brought my cost basis down enough that I'm actually up in the thing, which is unbelievable.
I just want to before we do the Disney's earnings, just back on that risk off, risk on thing. When it's like a risk off day, like when the market's getting hammered, a lot of times you'll see like your Johnson & Johnson up on the day, or your UNH, your more conservative stocks, right?
Yeah.
And those will be, but that's not the greatest sign. But I just wanted to do the risk on, risk off. Obviously tech, the IWM, into Bitcoin. Those would be your risk on assets. But Dennis, you made some good calls over the years. But the House of Mouse, did you trim going into the report?
I did just a very small piece, 1/4 of the position. So I took 3/4 through. I trimmed just a small piece, but I might trim a little bit more here today because it was such a big position. But I'm still going to hold the core position. They were like, because I still have the thesis that I still like Disney. I still think it's going to be a big part of the metaverse. The stocks have all come back. I've been trimming everything in the long-term portfolio just because we've had such a run. We got 50% of the losses back in the overall market here in 5 weeks. So I just think it's prudent to trim. So I don't see it. I don't see a V bottom. The only reason you buy today, this is the only reason to go long in your long-term portfolio today, is you think is going to be a V bottom. We're going to Cameron Dawson. We'll get her thoughts on that at 8:35. But that's really the only reason to be buying stocks today, because we went like this. So you went, boom, boom. To buy today, you think we're going right back to the highs. I don't think that's happening. I think this is, I think there's a lot of things unknowns. I think there's a lot of problems here still. I know Biden's saying, we had 0 inflation in July. Very exciting. Yes, but it's inflation. We're still up year over year, 8.5%. So a little disingenuous.
A little bit away from 2%.
Yeah, a little bit disingenuous. He's on there. We had 0 inflation. We brought this down to 0 inflation. Yeah, because prices just went absolutely astronomical. I mean, I feel like that's disingenuous. I wasn't, I'm not getting political here, Biden, Trump, whatever, Democrat, Republican, but I just felt it was disingenuous to be talking like that. So that we have zero inflation and bragging about it in an environment where we're still 8.5% year over year.
And why did inflation not go down as much, right? I mean, the core inflation came down pretty significantly, but if you look at the CPI report, you see more and more that it's the rent prices, the shelter that's keeping it up, and that is sticky. That doesn't change from month to month as much as you could see oil prices change. And so in my eyes, will this keep the inflation higher and keep the numbers closer towards that 8%? Then coming down towards 6% or 7%.
Man,
so
it's gonna be tough to get it down.
It's going to be tough to get that number down, right? You can see oil change in a heartbeat, but you don't see that shelter number change too often. And it just keeps increasing. And you're hearing more and more mentions of now something called the rent crisis, as people are starting to call it, because rent is just continuing to skyrocket on real estate out there. And I mean, the big part of this also is when you had all that liquidity and those cheap interest rates, some of these bigger companies went out and they bought a lot of the supply that was out there. And now they're re-putting it up as rent, and they're putting it up significantly higher, right? And so they have the supply. So these bigger companies are making the money, the property management companies, and it's causing some issues there in the inflation. But let's go to Disney. Let's talk about Walt Disney's numbers here. Yeah. EPS Q3 coming in here at $1.09, beating the $1 estimate. Sales at $21.5 billion, beating the $20.49 billion estimate. They reported 14.4 million Disney Plus subscribers added in Q3 2022, beating the estimates of 9.8 million. So big beat there on the subscribers gained. They did lower, though, 2024 guidance, and that's just a further outlook there. Disney said that the main Disney Plus service, excluding Hotstar, to reach 135 million to 165 million on the high end for the end of fiscal 2024. Now, one thing that they did start doing is a couple of price changes. I'll show you guys a little bit about that. I just have like a quick image to describe that. Let's talk a little bit about that. Let me take off these banners here so you guys can see this a little bit more. And so the price changes here, Disney Plus now coming with a subscription ad plan, right? And so they added this, they pulled the Netflix on this, and now Disney will have the basics with ad at $7.99. Premium with no ads at $10.99. Hulu will have the same thing, and so will ESPN Plus. And then they also adjusted their bundle package, which is also something that you see a lot of people get. And their bundle package is now going without ads. It's going to be $12.99, and without ads, it's going to be $14.99, and with ads, it's going to be $12.99. So they increased the bundle package without ads for $1, and they lowered it by $1 for with ads here. Let's talk a little bit about their park numbers, because I know that everyone was thinking the parks were going to kill it, right? So the parks and experience revenue was at $7.39 billion, up 70% year over year. Estimates were $6.65 billion. And the main driver really wasn't the parks. It was the U.S. resorts that drove the money there in the park experience and product revenue line.
Lots to take in there, Mitch. I mean, the bottom line here is
they give a lot. They don't give a little bit in their earnings.
The bottom line here is I think we need to start looking at a potential 50% retracement of the overall move.
Whoa.
And it's still a lot higher because this really has gotten killed. I mean, you could take the recent move from the 180. It depends where you want to grab it from, 180 to 90. So, ballpark 135, 125. You're getting into this gappy area too here, though, Joel. Like you're getting into an area where, we went down fairly quickly through, and now we're coming back up in that area. I'm long Disney. It is I believe the biggest position still in my long-term portfolio. So I'm pretty happy about this move here today. I might trim into it a bit just because it was an oversized position. Might get it to a normal size position because it's literally went up. You got to respect that I was wrong with the call. I was early with the call, and it's went from 90 to 123 here 33 points. You're talking about a 40% move in 3 weeks. I mean, same thing, same reason I trimmed my AMD position. It wasn't that I don't believe in it. It's just that I got it really wrong. And the stock, literally is just bailing me out. So in AMD, Disney, I mean, I still held some AMD, holding the initial core position, but trimming the extra stuff I bought for the simple reason that I thought it was way oversold. It's not oversold anymore.
Boy, oh boy. Certainly a wake-up call to the shorts in this issue here. Holy mackerel, blowing the doors up, 1074. Once again, you're making new highs here in the pre-market session. So I can't say, lean on the pre-market high. I'll just go to the next area of 2 daily highs. And that comes in 26.45, 27.35. So if you're looking for more on the upside, you think this thing's just going to keep on going, I would look for those for targets. But this is probably double or triple or quadruple its average daily range. So 126.45 if you feel you want to let some go today, and then the next daily high 127.35. Where to buy this? I'll leave that to the experts.
How does this report go and affect the relationships like Netflix? We saw Netflix running a little bit
kicked it off
yesterday.
Netflix kicked it off.
How do you think this will?
And that's come back a long ways too.
Yeah.
Here, I've been bag holding this thing forever here too in the long term. Well, my wife, I guess, been bag holding it. But you're coming back to the price of memory. 248.70 was the high from the gap down day. I think you challenge that. I think it's a serious resistance point. Then you get into the gap. I don't know if it's going to let you into the gap. What do you think, Joel? Is it going to let you in there?
Oh yeah, for sure.
You think so? Well, nothing.
I mean, I don't know if it's gonna fit. I mean, if the tempo of the market, keeps up here, yeah. I mean, it's gonna take a long time. You probably won't, need another earnings report or something to go up. But really, Netflix kind of, kick things off. And the other thing, with Disney is creating those extra packages and raising prices. When you can, right? When your subscriber growth is going, they got that working for them. I guess they're not worried about attrition there, right? They're pricing people out. They're hooked on it now. And, just Netflix and Disney, proven to be the winners here. Nothing here. I mean, Dennis gave you the one level to look at in Netflix, and that would be 248.70. Easily see that today over the next couple days.
Something to keep on watch. We'll see how kind of ESPN's growth was. I did see the ESPN subscriber growth grow 53% year over year. I think a lot of that had to probably do with the hockey move that they had. Dennis, do you think that was attributed to that?
I don't know. This is beyond my pay grade. We get into the fundamentals this much. It's no money in it, so I don't even analyze it. That's the truth. There's no.
No, what I was more along saying was because I mean I don't know too much hockey.
I'm just saying we're going.
I don't know too much hockey there, but
this is not my style. It's not my style to go like really deep and analyze the. If I was sitting there and wasting my time analyzing every little aspect of a report, if you trade one stock or 5 stocks, you can do that. When you're trading hundreds of stocks and bouncing all around, it's just time. It's no time. That's why I listen to 0 conference calls. Never, ever listen to a conference call. Never, ever dig into the reports. The reason is it's all headline driven anyways, because the algos aren't even doing that either.
Dennis, you gotta write your book already, man.
There can be some fundamentals. There is some case, where you're a real hedge fund manager, you're making 2 trades a day, and you're really analyzing the hell out of the things. But anybody who's actively trading, you're wasting your time really digging into the reports. What was it, ESPN? Oh, was it this? No, that's wasting your time, man. I wouldn't even do that stuff. It's charts, it's headlines. That's the way that active day traders should be focused. It's how I focus, and I think it's the way for active day traders. So you're a long-term investor, you have 5 stocks, Disney's one of them. Dig in there. Maybe you'll find something. But I think 99% of the time, you're probably wasting your time.
All right, so let's go to the next topic. Let's go to the financials coming to life.
Boy, oh boy, we talked about this a little bit. They wouldn't move up with higher interest rates, because worried about a recession. And I don't know. I mean, XLF had a breakout yesterday. Bank America broke out of that long consolidation, trading up 48 cents. I mean, Could you have some money coming out of Pharma going into the financials? Sure. I mean, they're not super sexy, but if you're looking to buy today, and you're saying, I would say the financials, they had a good day yesterday. They're still priced from the bottom here, but nice move. And it's the fear of the recession seems to be abating, and I think that's what was holding the banks down. But nice move in them yesterday. They're not super sexy. I don't know if I'd put them in a super risk on category, but they had a nice move yesterday.
All right, now we'll give the estimates here for the numbers that will be coming in just about 3 minutes here. July producer price index, PPI month over month estimate at 0.2. Prior was 1.1. So a huge difference there from the prior. That's one thing that I noticed yesterday with the CPI number and the core CPI number, that I feel like a lot of people paid attention to the prior and the month, right? And how much that changed in the core CPI. So pay attention also to core PPI right now, month over month. Estimates are exactly to the prior. So 0.4 is the estimate and prior is 0.4. So one thing you notice is there in the overall producer price index, there's a big change there in the estimate to the prior, but in the core, it's actually the same number. That's what I'll be paying attention. You also will get initial jobless claims to hit. Last week was at 260,000. Estimate is 263,000. We'll see how these kind of perform. Last time it did beat the estimate a significant amount on the upside, given a little bit of room there for the Fed, of course. A lot of people are going to be watching to see if PPI just comes in lower than expected and it's not hot and we're really starting to see inflation peak. This could give us another lift today. I know I'm seeing a lot of stocks kind of getting strong here towards the open. SPY's been going up here since about 7 a.m.
It's been strong, yeah.
Yeah, it's been strong, right?
Yeah, well, they were leaning into that. They were leaning in that report long yesterday, right? They were. I mean, even the Gunners at 829.30, they were pushing it. Here you get into an area of just like I showed you on the dailies. There's no daily resistance. There are some other ways to come up. A psychological number
I'll
might
be
be
back.
4250. If we start to go into reverse, I have the 1 minute chart here. If they start to slam it, we've had like a 30-point move. So, maybe 4520, 4521. I think the big number we got was yesterday for the most part. But there is a strong bid in the market here, trading right near the highs of the pre-market session. So we will see what the PPI data imminent here coming up in just a matter of seconds. As mentioned, 3 ticks off the high of the day. You do have still have your Pharma trading in your red. That's really the only negative. I see ExxonMobil trading down just 15 cents. So as the world waits for that PPI data, we will wait too, and it's light, and the buyers are push us 42.45. They like it. Right now CPI data confirming the PPI data. What do we got? Looks like we get the actual number. The early Gunners came in there and they thought it was soft.
July 0.2 versus 0.4 on the core, so lighter there. And then trying to get the overall number there, but I wanted to pay attention to that core. It came in light there, so that's a good sign there. I'm going to give you guys the numbers right up at the top here. I'm still looking for the initial jobless claims also, but here month over month core PPI at 0.2 versus the 0.4 estimate prior was 0.4. That's going to help out a little bit here. Initial jobless, continuing jobless claims. Initial came in at 262,000 versus a 263 expected here. And now I'm looking for PPI here that's not the core one. Just give me 1 second here.
Yeah, Bob, I'm seeing they fell
0.5 demand.
0.5 versus estimate of 0.2. It's still
So
high on it's still high on a yearly basis, 9.8%.
Yeah, here it
versus the
is.
estimate of 10.4%. And then you gave the jobless claims numbers. So right now, I mean, as I said before, we're just in an area here of very, very little resistance. 42.47 had backed off a little bit, but those leaning long into the report here at least have been being rewarded, trading up 31 and a quarter handles. Any more detail on that? That the Fed's plan may be working here?
No, what kind of not too off of what we expected there. The core one was an impressive one at the 0.2 versus the 0.4. The PPI month over month estimate was 0.2, coming in at 0.5, not coming down as fast as expected there. The prior was 1.1. So there you guys see it, at least in core, it came down a pretty good amount from the estimate, but the overall not coming down towards that estimate there. So showing a little bit more stickiness in inflation there. Initial jobless claims at 263. That's not bad because it came in at 262 versus a 263 estimate. So not too off of the estimate there.
Okay.
All right, let's get out of that. Let's go into our interview today. Let's dive on in. You guys were excited when we mentioned it right out the hop. Let's dive into it. Like always, we're going to get in with Cameron Dawson here, CFA and Chief Investment Officer at NewEdge Wealth. Welcome back, Cameron.
Great. Thank you guys for having me. Good to see you.
Excited to hear your opinions on what's been going on. You guys put out such an extensive deck there that there's a lot to talk about. Let's go through it. Joel, you can start us off.
It's like a 6-week course looking at that. Great information. But before, I mean, let's just go over, just real quick, and the new information that the market has given us over the last couple days. We're waiting for inflation to come down. Are you looking at it? Is this just like, like, do you need to see it come down 1 month, 2 months, 3 months, or do you think peak inflation is finally here?
Yeah, that's really been the push-pull in this, because markets always trade on the rate of change, and it's not necessarily the level that matters, but the momentum that matters. As a cyclicals, you'll always talk about second derivatives. And so the fact that inflation is rolling over certainly seems to be giving people confidence that we're moving in the right direction. But that's kind of counter to what the Fed is saying. The Fed is saying, yes, okay, we see that it's peaked, but it's still so far above what our target is, and we're not willing to call victory. So we've been talking about this kind of really game of chicken between the bond market and the Fed, where the bond market's saying, yeah, well, we think you're going to end up cutting rates, and the Fed's saying, absolutely not. Because the Fed's worried that if they do cut rates, they could actually cause inflation to reignite again and start accelerating. And so I think that really remains the big disconnect between markets today, because clearly a lot of this equity rally is based on the back of the lower yields we've seen since the June Fed meeting, and that has boosted valuations. And the question is, does that continue, mostly as we start going into a more intense period of quantitative tightening that we get in September that could cause some volatility in the back end of the curve. But at this point, as you've been saying all morning, Joel, there's not a lot of resistance within the daily charts of the S&P 500. So the momentum is certainly to the upside, but then I think we have to start asking some questions once we get to that resistance.
All right, so we've trimmed the mean CPI, and we've talked about the other components, but talk about the sticky CPI that perhaps is not peaked, that could rear its head in the upcoming months.
Well, that's really important, because the Fed has told us that they look at that, whether it's looking at the Atlanta Fed sticky CPI, which what that does is it takes the very volatile components and it looks at the more the slower moving components of the CPI. And that has not peaked. That still remains near 30, 40-year highs. It's not rolling over yet. And that includes very important things like the shelter components of the CPI. CPI. So that's rent and housing. And the important thing there is that those shelter components lag housing price data by about 4 quarters. And so even if we start to see house prices roll over, and it's important to note that they haven't, even though we've seen weakness within the housing market or a slowing in a housing market activity, house prices have not really started to roll over on a national basis. That's going to keep those sticky components of the CPI very elevated. The other one to look at is the trimmed mean CPI. That throws out the extreme readings on the top end and the low end, and that hasn't rolled over either, which tells you that inflation is still very broad. So when we think about the Fed's reaction to the data, what they'll look at is they'll say, okay, we get the headline numbers rolling over, and if we look at what drove that headline deceleration this month, it was mostly energy prices, but we also saw things like airfares and used car prices start to pull that headline month over month number to that zero level. But the challenge that they have is that these sticky components and the breadth of inflation likely means that inflation readings stay well above their 2% target. You add on top of that wages that are still growing 5-6%, those are sticky as well. And so the question is, if we start seeing this moderation, can the Fed claim victory even as you're seeing these sticky components stay elevated?
Yeah, let's go a little bit more into the wages, because that's something that people don't seem to mind a whole lot, right? With inflation, is the higher is the higher wages. One thing that kind of kept me out of the the bear recession depression camp was the employment situation. The want, the help wanted, the people need to work. I mean, let's just go a little bit more into the stickiness of wages. And I mean, people are not, with rising inflation now, increasing inflation, it's going to be high. I mean, the might be the last thing to turn around and come down.
Yeah, wages and labor in general are always backward looking indicators because they take a long time to respond to changes in the economy. Companies usually are not very quick to do layoffs, and it's very hard to cut wages once you've raised them. And so it's likely that we still continue to see the strength in the labor market. And it is wild that we're seeing non-farm payrolls stay very strong while initial jobless claims do start to tick up. So maybe there's some signs, some very early signs of some easing in this tightness. But if you look, even things like job openings, the JOLTS report, that still remains extraordinarily elevated. So because we're coming from such a period of tightness within the labor market, as we see a little bit of easing around the surface, it's certainly not opening things up where companies are having ease in finding labor. That NFIB small business survey, I show the compensation plans here, that's kind of come off the boil some. But if you look at the jobs being hard to fill, that remains very elevated. So to your point, Joel, that really goes against this notion that we're already in a recession. The fact that we added over 500,000 jobs last month, even though a lot of those might have been part-time jobs, and I understand the constitution of it was a little bit different. But that would argue that the recession isn't happening now. That doesn't mean we don't go towards that direction. If you look at things like the ISM survey of employment for both manufacturing and in services, you start seeing that there's some weakness, there's some softness that can typically be a good leading indicator. But at this point, the labor market remains tight enough that people are able to demand higher wages. I think the last point there, though, is that real wage growth still remains deeply negative, and it's been negative since April of 2021. And that actually coincides with the drop in consumer confidence. So consumer confidence at the University of Michigan survey really started to fall off a cliff around that April of 2021, because that's when people started losing purchasing power. And that really helps to explain why consumers have felt so terrible for so long. But it doesn't seem at any point that we're seeing an easing in that real wage growth where it's turning positive. So that also explains why you've seen this big surge in some credit card spending, bridge the gap between what you want and what you can afford. But at the end of the day, consumer balance sheets still remain fairly healthy. So it's, you're seeing deterioration, but you're not to the point yet where you say the consumer from a credit perspective is in danger like we were in like 05, 06.
Now, what do you feel, Cameron, really changed inflation? What caused us to peak here?
Well, it was certainly gas prices, oil prices. That was the big driver. You saw a swing in the month-over-month contribution for energy prices. They added 60 basis points to the month-over-month number from May to June, and then they detracted 40 basis points from June to July. So that's a 100 basis point swing, and that explains the majority of this move in inflation. It also, as you show here, explains the majority of the mood in inflation expectations. So you would think that if consumers were interviewed about what they think inflation is going to be over the long run, they may not look at gas pump prices today to determine what that is, but that's actually the case. There's a very strong relationship between gas prices and inflation expectations. And so when we saw the July reading of inflation expectations fall to a one-year low, that's because we had seen a consistent day after day decline in gasoline prices. They've fallen almost $1 since the June high, and it's been a consecutive over 55-day move lower in gas prices. Now, the caveat there is that we're kind of tied to the hip with gas prices then, meaning that both our inflation readings and our inflation expectation readings will remain very sensitive to energy prices. So lower energy prices likely is a boost to markets, meaning lower inflation. Higher energy prices could cause some more fear to enter markets.
So I'm just, and Cameron here, sorry, I just came back in. I was trading the PPI number, so I was a little bit late to come in here. But just listening to you the whole time, and like it sounds to me like it was commodity driven. The relief that we just saw in these inflation numbers, commodity driven, which was kind of predictable. What about other things? Like, can we jump into, like, is there other stuff that obviously we get relief from the commodities, but I mean, we're still, cooking pretty hot here. Was there other things that were ticking higher?
Yeah, the one component that actually accelerated in the month over month this past month was food prices. So that's interesting given the fact that we actually have seen soft commodities roll over quite significantly in the past couple of months. But if we look, there's still many components that are running at very, very high levels, double-digit levels. And you can break down all of the CPI components. And what you see is that services is still accelerating. That's important because services is a bigger part of the CPI than goods is, and it tends to be stickier.
Yeah.
So services makes a new high, and it really is looking at durable goods that's rolling over the fastest. And that's that whole shift from goods to services. You bought a grill in 2020 or 2021. You don't need to buy another one. Inventories are ticking up. There was a chart going around this morning showing furniture inventory to sales being quite high. So what you're likely to see is a lot of you could even see deflation in durable goods, meaning falling prices, because now we have too much inventory. And consumers have pulled forward demand. Now, the problem you have is that services is still moving higher. So it really will be a matter of which one nets out to be the number of the direction where we go with inflation.
We're on the line with Cameron Dawson, CFA, Chief Investment Officer for NewEdge Wealth. We talk about a lot of different things on the show. Obviously, the futures, the stock index futures, crude, gold, Bitcoin, whatnot. But we really don't put a lot of emphasis or talk a lot about the euro dollar. Mm-hmm. And I see you've included that in your deck as the euro dollar futures pricing in an earlier start to rate cuts. High stakes chicken with the Fed here. The Fed doesn't seem they want to do it. How should the average investor, try and look at the dollar, euro dollar, situation, or changes it and let that be somewhat of a factor in their investment decisions?
Yeah, so the euro dollar is important, and at first we have to acknowledge this is not the currency. This is not the euro dollar currency exchange rate. Euro dollars are borrowings that happen outside of the U.S., and so they aren't necessarily predictions, but they are ways that big owners of bonds, big pensions, other companies, banks, it's how they're hedging the positions within their large portfolios is through these euro dollars. And what we're seeing is that these big players within the bond market are starting to essentially buy protection with the idea that you're going to see rates moderate in 2023 because of maybe something bad happening, meaning that the economy gets weak enough that you start seeing the Fed having to consider interest rate cuts as we move into 2023. So again, it's not a prediction, but it is a reflection of the fears out there in the market and what's being priced in. Now, the interesting thing is that if we look at the 2-year yield, that remains extraordinarily important for the path forward for the Fed, for what the US-based kind of domestic bond market is saying. And even though we saw the 2-year yield initially lower, so meaning the bonds rallied, the yields fell yesterday, we actually saw the yields kind of rally back near the end of the day. So initially the bond market was saying, oh, we don't think the Fed's going to have to raise interest rates as much, and they might even be cutting rates. But then the bond market kind of rallied back. You saw this movement back in yields, and you're still seeing the 2-year yield, though it's not really rallying high. It's not in this, this strong uptrend like it was earlier in the year, kind of losing a little bit of momentum, but still above its 50-day moving average. It hasn't rolled over in a meaningful way. So until that rolls over, it would be doubtful that part of the bond market is really pricing in imminent rate cuts.
All right. So after a big rally like this, I mean, it's difficult, right? Do you chase? Do you chase? Do you sit back? I mean, now, and we talked about this earlier in the week. I mean, you're just, for the people waiting for the retest of the low, that's just getting farther and farther away. And I'm also of the persuasion that I don't want to retest that low, because if we retest it, we're going down, we're going a lot lower. Is this time to take a chance in the market, looking at this rally and just saying, okay, yeah, I missed 600-700 points in the S&P. Is it too late to take a chance?
Well, I think there's a few important points there. The first one is what we've seen in momentum and breadth in this rally, which has been very different than the other rallies that we've had year to date. A lot of the market, bear market bounces that we had were very anemic. They didn't have any momentum. Breadth was really weak, meaning that there were only a few names participating. And that has been different this time of year, this time around. And we've also seen some cyclicality leading out of this rally. So things like small caps doing better, coming off the lows. They actually bottomed versus the market in April. So that would support a notion that as you've seen better breadth, as you've seen better momentum and cyclicality, that it reduces the likelihood that you retest the June lows and that you actually make new all-time lows. Now, of course, for this bear market, you could have a scenario where you have a liquidity event, some kind of black swan event, which would take us much lower. But that's not something that we can predict in the very near term. So I think that the reality here is that the likelihood of a retest is lower. Now, to Dennis's point earlier in the show, which is, would you buy today? Would you chase this rally? And we think the answer is no, because we don't think that we are set up for a V-shaped recovery. And I think that that's really important here, because a V-shape, obviously we've had a V-shape coming off the bottom, but are we going to enter into a brand new bull market from here? Meaning that we take out the prior all-time highs and we continuously go into these new highs. And I think that's really challenging given the posture of liquidity in the Fed, meaning that we don't have a Fed that is going to be adding liquidity to this market anytime soon. That's so, so critical, because that's what gave the power for rallies like in 16 or 18 or 20 to have multi-year rallies coming out of that, because of that movement to a more abundant liquidity environment versus today's world, which is a more restrictive liquidity environment. So the Fed going from 75 basis points to 50 basis points in rate hikes is not adding liquidity. It's just slowing the pace that they're taking it out of the system. But the other point, and this is very related, is on valuations. And this really speaks to the fact that we started from such a high valuation starting point to start this year, that even though we saw this big market decline, valuations from a historical perspective never really got that cheap. And in this rally, we've seen valuations surge to about 18 and a half times. And that isn't cheap from historical standards. And really, the way we think about it is that there's only 3 reasons to pay more than 20 times for the S&P 500. And we could debate if, because of the constituency of the S&P 500, better ROIC names, better margin names, and things like tech, that the overall multiple should be higher for longer. But even if we go back to the peaks that we had in 18 as well as in 19, we peaked out, right under 20 times. And so what would cause you to want to pay more than 20 times for this market? The first one would be that earnings are so bombed out that you're willing to pay a high multiple for today's earnings because you expect them to recover quickly in the future. Kind of like what you saw in 2020. You can put a huge multiple on earnings in 2020 because in 2021, we had 50% earnings growth. And so if we had that scenario, then that would be a reason to pay a high multiple. That's not what we have today. Of course, earnings haven't been cut in aggregate for 2022. And 2023, they're still set to grow another 8%. The other reason is if the Fed is flooding the market with liquidity. Already talked about that. It's not likely to happen in the near term, just less liquidity being removed. And the last one is if we're in a bubble. And we can argue that we were in a bubble in 2020, 2021 in certain parts of the market. And that's just because when valuations go high, they stay high in a bubble. But that doesn't seem to be the scenario we're in today yet. So when you put all those 3 things together, we think that the valuation of this market acts as a ceiling. Even if I rolled numbers forward to 2023, $244 a share in earnings, we're still at 17 times if we rally to 17 and a half times if we rally to 4,400. That's pretty expensive in this liquidity environment. If you even look at growth stocks, I think that one's even more important. We've talked a lot about the relationship of real yields and gross valuations. They move inversely. Higher real yields, lower growth valuations, lower real yields, higher growth valuations. And what we've seen is that as real yields have lowered in the last couple of months, you've seen growth valuations absolutely skyrocket. They're now trading at 26 times. That's above the peak of the pre-pandemic peak back in late 2019, early 2020. So these valuations aren't cheap. They can still get more expensive if real yields start to fall again. But if real yields rise, then I think that those growth valuations are at risk.
One more here. Non-U.S. equities continue to struggle. I think the first time we had you on, maybe we were looking for China to pick it up a little bit with their stimulus. That's a whole different situation here. But are you better to keep your money at home, or do you think that there's some enticing opportunities in non-U.S. equities markets?
Sure. I think on a single stock basis, there's, obviously always some kind of idiosyncratic opportunity. But the argument here is that these indices, both the EFA International Index and the EM Index, are value traps. And it's always, and I'm sure it'll happen again this year. At the beginning of the year, a bunch of strategists will come out and say, by international, US is going to underperform. But what's happened is that these have been in consistent and persistent downtrends on a relative basis, and that we've actually been making new lows on a relative basis. And so the argument usually goes, oh, well, these are so cheap versus the US. And yeah, they are. They're trading at 30-40% discounts versus the US, but those discounts just get continuously wider. So one of the things that we did is looked at earnings growth in the US versus international and EM since 2006. The reason we chose 2006 is because that was the peak in the international cycle. And what you see there is that though the US has grown earnings over 150% since that 2006 point, the international and EM indices have grown earnings less than 10%. So there's clearly a fundamental driver of this. This is not just about valuation. And so what the driver that we're looking for, the catalyst that we're looking for to become more constructive on non-US markets really is a weaker dollar. And a weaker dollar was so important to the big rally and outperformance we saw in non-US markets in the early 2000s. You had a 40% depreciation in the dollar during that time, and that led to this huge rally that we saw in these non-US assets. So unless the call is that we go into a period of very marked, pronounced, and prolonged dollar weakness, I think it behooves investors to remain doubtful that these indices, international and EM, are worth an overweight.
All right, that's going to do it for us today. Thank you, Cameron, for, I mean, I saw people in the chat, they were just putting the blowing the mind emoji, and I think so. You just blew our mind there with so many stats and outlooks on different types and parts of the market. If you guys haven't looked into NewEdge Wealth, I think you might need to go ahead and do so. Cameron, kicking it out the water. We'll appreciate you coming on back.
Great. Thank you, guys.
Thanks, Cameron.
All
All right,
right.
S&P's back up at the highs. Go ahead, Mitch.
Yeah, a lot to dive in there. I mean, we could go into Cameron's interview there all day long, but let's take a quick look. Looks like the markets did not care about that PPI, and we're still in full breakout mode here.
Well, I thought the number was fine. So, I mean, this market is
good.
This market is a silver lining market that give me something okay, and we're going to buy the hell out of the stocks. I mean, the only fear, you know, to the point Manny, one of my Twitter followers there, is just saying this market just keeps ignoring bad news. This market, he's saying that they don't fear anything, and he's exactly right. The only thing this market fears right now is missing out. That's all anything going on here is FOMO. People are all just like, I got to buy stocks. This is it. The bottom is in. I got to buy. Again, to Cameron's point, you had to be doing that 5 weeks ago, because we just rallied half of it back. You're paying 20 times multiples on earnings that may not, you know, if we go into a recession, these earnings are going to come down and you're going to be paying even more. So you got to consider that too. Like, did the economy all of a sudden recover because inflation stopped going up for a month? It's not like we're back at 2%, and it was all helped by gas. These wages are not coming back down. People don't take wage cuts. You know, and people are still looking at their bills. And again, it takes time to go into the economy. I mean, when you raise rates, when you raise interest rates to slow the economy, it's not just all of a sudden everybody's broke. They make the first payments, they make the next payments. Okay, well, we're getting a little tight. Let's not buy the toys. You know, let's not buy the fancy furniture. To Cameron's point again, you know, seeing inventories and some of that stuff maybe start to build up. Slow and steady, though, eventually the consumer is strapped. And are we, you know, in this environment where the Fed can start lowering rates aggressively to help this market go? I don't think so. I mean, I don't think the inflation is, I think we slowed it, we peaked it, but we haven't started really bringing it in yet. So, you know, you can say, oh yeah, it was zero. So, oh yeah, it's back to zero. But no, we're at inflated, ridiculous prices for 1 month, 8.5% still year over year. And there's going to be other things that are catching up. Like everybody I talk to in businesses, small business, is raising their prices. And, you know, you ask why, and they're like, well, because everybody else is. I'm like, so it's just an excuse to raise prices. Well, we have to raise prices too. You've got to break that mentality. And the only way to do that is to break demand. We haven't even broke demand yet. So we're still in the early innings on, you know, trying to break this down. Yet the market is already looking past it and saying we've beat it. That's nonsense. So I think this is a gift. I think the S&Ps, to rally back half of the losses in 5 weeks is a gift. I think everybody's looking at their portfolio and they're feeling a little bit better about themselves. I think time is to raise more cash again. 5-6 weeks ago, stuff was oversold. It was, it got to a point where, okay, we've just priced in a lot of bad news, but all of a sudden we've priced in a lot of good news. So I think we got to just keep our head on straight, look at this from, the overall picture of what's going on and still the China wild card over there, and maybe take some profits into this, even though we're going through 420. Maybe we're going to be bottom. Maybe I'm going to be wrong, but I don't think we are. So, and that's where my bets are, and that's why I'm taking chips off the table.
All right, let's go ahead. We'll wrap on up. What are the levels to watch today, Joel?
There's nothing to watch on the upside.
Nothing to watch.
Nothing to watch. I can't give you the next day. We could develop something over the next couple days, but you got your pre-market high at 42.47, and your next daily highs are at 43, right at that 4,300 level. Who thought we'd be talking about that a little over 4 or 5 weeks ago?
All right, I'll go ahead and I'll get Joel on out of here. Check him out on PreMarket Prep Plus, or definitely check him out on the Intro to Swing Trading with PreMarket Prep, hosted by Spencer Israel, Joel Elconin, Dennis Dick, and Rob Friesen. I'm going to go ahead and play the trailer here. Joel, you have a great one like always, and we're going to keep watching to see what happens in this market. But if you want to learn a little bit more about swing trading, come on over to the introduction. All you got to do is go to premarketprep.com. Then you want to go ahead and use the promo code that's only for the PreMarket Prep users and people that watch us on the daily basis. PMPP10 is your discount code for that event. Check it on out.
Are you tired of being sucked into momentum stocks just as the momentum turns the other way? Do you not have a big enough account or tired of the complexity for options trading? Well, join PreMarket Prep's introduction to swing trading. This is going to get me fired up. Learn event-driven trading, seasonality, sympathy trading, and you can stay on top with optimal hedging strategies. So welcome back, Spencer Israel, from the market hiatus, and learn along with Tim as he hones his trading and investing skills. August 18th, 12 p.m. Eastern to 3 p.m. Eastern. You think you learn a lot every day listening to PreMarket Prep? Learn how to become an investor that can survive the swings, ups and downs in this volatile environment.
All right, traders, I'm going to get you guys on over. Next up, you guys got live trading with Benzinga. And check out today, we got an interview from Qualcomm. Yes, I said it, guys. Go ahead and check that on out. That's going to be a great interview. That's going to be coming at 1:30 on Stock Market Movers. Don't miss that, guys. Do you want to see the interview from Qualcomm? You're not going to miss that. That's the CFO from Qualcomm. It's going to be really fun to talk. Chris Ketchy is going to be doing it on Stock Market Movers. So don't miss out on that play. It's going to be really fun. I know I'll be watching it here. But definitely, guys, tune into that. It's going to be a great time. I know I need to find out what's going on in tech. Are there some worries of Qualcomm? We saw worries of Micron, NVIDIA. A lot of people are going to be watching this. Tune in. That's going to be at 1:30. Up next, you guys got, of course, some live trading action. We've been killing it out the water. I'm going to continue trying to go on my green streak. We'll see what happens today. Get on over to live trading up next, and I'll see you guys continuing the day. Let's go. Let's see what we got today. We're going to keep going. I think I'm feeling a little bullish today. Let's go.